Greetings to one and all. I am J. Suhashini, working as an assistant professor in Department of Management Studies, PSNA College of Engineering, Dindikal. Today, we are going to see about the video lecture on working capital management. Welcome to this session on video lecture of working capital management. Whenever we are investing capital into the business, the capital whichever we are investing is deployed into the various aspects of the business. One such deployment of the capital is known as the working capital management. The finance manager has to make sure that the working capital is properly used, as such the fixed assets whatever they are using. So let us take a outline of the contents what we are going to see about the working capital today. So we are going to see about the meaning of the working capital management, need for working capital management, what are the various types of working capital management, approaches in working capital management, and what are the various factors that influence the working capital management, and the case study on working capital management. So working capital management is a branch of financial management. Working capital management is known as the nervous system of the business, whereas financial management is known as the lifeblood of the business. With the proper management between the balance of the financial management and working capital management, even a small business can have a huge profit of the enormous large of the business. So let us see what is the working capital management. So working capital is nothing but sum of all current assets. So current assets is nothing but the assets which are employed in the day-to-day operations of the business. All those assets are called as the current assets. So employment of current assets in a good profitable manner for getting a good return on investment is called as the profitability, and maintains the viability of the business for repayment of various debts is called as the liquidity. So whenever we are using the working capital, you have to keep in that, so they should have the good profit on the business, the well return on investment of the business, and also you are having the good solvency position where you have to make out the repayment of all the business debts. So here we are going to see about what are the various aspects to consider in the working capital. So the first thing what we are going to see is the finance manager, whenever he is going to manage the working capital, he is considering a good time for making the calculations of the working capital. So next one what he has to say is, he has to see that what is the investment avenues what he is going to make for the working capital. So all those investment avenues is to be maintained with the good profit. And the third one is, he is going to have the growth on the business. So whatever the capital you are going to employ, whether those capital is having a good growth or not. And next one, it is called as the critical evaluation. It means that whatever the finance manager is doing, so it is very important to evaluate in a critical manner. So what are the goods and what are the bads in that particular management. So whatever the decisions you are taking, all the decisions will be put forth for the effective management of the working capital. So let us see first, so what are the various types of working capital. So here the types of working capital may be it is the permanent working capital, or else it is the temporary working capital. So here the temporary working capital is the capital which is used then and there. So it is based on the seasonal business. So whereas the permanent working capital, so it is used on the regular basis. For the day-to-day business, so the working capital which is used, that is called as the permanent working capital. Whereas when the temporary basis is based on the seasonal basis. So whenever you are having the seasonal businesses, so that time when you are using, so that working capital is called as the seasonal working capital. So sometimes it can also be used as a reserve working capital. So for the various contingencies what you are helping, So for that contingencies, when you are using that working capital, so that is called as the reserve working capital. Apart from this, there is a special working capital. Special working capital is nothing but the working capital what is used for the special avenues, for marketing campaign. Sometimes it may be used for the research and development. So all those such working capital is known as the special working capital. So again, on the basis of time, it also divided into various aspects. So on the basis of concept, it is divided into negative working capital and also the positive working capital. So the working capital is the combination of both the current assets and current liabilities. So gross working capital. Gross working capital is nothing but the total of all the current assets. So that is called as the gross working capital. Whereas the net working capital is current assets minus current liabilities. So that is called as the net working capital. So here, when the current assets is more than the current liabilities, then it is called as the positive working capital. When the current liabilities are more than the current assets, then it is called as the negative working capital. So what are the current assets and what are the current liabilities? So the current assets are those assets which are used for the liquidity within the year for the day-to-day business operations. Example for current assets we can say as cash, stock, bills, receivables and debtors. All those are called as the current assets. Whereas the current liabilities are those who are called as the creditors, supplies of the raw materials and also the loans, short-term loans what you are getting from the business and the bills payable and also with the short-term current liabilities, the tax payable, dividend payable, all this together is known as the current liabilities. So let us take a small video on the current working capital management so that we can understand that what is the concept of the working capital, definition of the working capital and what are the current assets and what are the current liabilities, how you have to make out the working capital.
Working capital. Working capital is money available to a company for day-to-day operations. The formula for working capital is current assets minus current liabilities. Let's take a look at a balance sheet for company XYZ. In order to calculate total current assets, you must first calculate the total amount of cash, marketable securities, accounts receivable, and inventory you currently have. In order to calculate total current liabilities, you must calculate the total amount of accounts payable, accrued expenses, notes payable, and current portion long-term debt. Using the working capital formula and the information from the balance sheet of company XYZ, we can calculate that XYZ company's working capital is $95,000. Working capital is a common measure of a company's liquidity, efficiency, and overall health. Because it includes cash, inventory, accounts receivable, accounts payable, the portion of debt due within 1 year, and other short-term accounts, a company's working capital reflects the results of a host of company activities, including inventory management, debt management, revenue collection, and payments to suppliers. Positive working capital generally indicates that a company is able to pay off its short-term liabilities almost immediately, while negative working capital generally indicates a company is unable to do so. One of the most significant uses of working capital is inventory. The longer inventory sits on the shelf or in the warehouse, the longer the company's working capital is tied up. When not managed carefully, working capital shortages cause many businesses to fail even though they might actually turn a profit. Working capital needs to vary from industry to industry, especially considering how different industries depend on expensive equipment, use different revenue accounting methods, and approach other industry-specific matters. Finding ways to keep working capital stable is particularly difficult for manufacturers and other companies that require a lot of upfront costs. For these reasons, comparison of working capital is generally most meaningful among companies within the same industry, and the definition of a high or low ratio should be made within this context.
So thus, we have seen in the video how the working capital requirement for the various business activities. So here we are going to see that how the operating cycle influences the working capital. So based on the operating cycle of the business, the working capital is very important. So the first one is the cash management. So the cash management is nothing but the day-to-day expenses and income what you are going to get in your business. So how you are going to manage the cash inflows and outflows of the business. So next one is, it is the inventory management. Inventory management is nothing but the conversion of raw materials for the work in progress and to the finished products. And again, when you sell those goods to the people, and how you are going to give the credit to the customers, and in turn how you are going to collect the money from the customers. So that is called as the inventory management. And the third one is that the receivables management. So here, when you are collected the cash from the customers, how you are going to pay with the terms of the suppliers. So the cycle of the payment of the customers, and from the payment of the customers, how you are going to pay to the suppliers. So how you are going to manage the payment from the customers and to the suppliers, that is called as the receivables management. In receivables management, you are going to see about the credit period, what you are going to get from the suppliers and what you are going to give to the customers. So here, based on the nature of the business, the operating cycle of the business differs. So when it is a manufacturing kind of the business, the operating cycle differs, where the procurement of the raw materials, and the raw materials is transferred to the warehouse, and where in the warehouse you are going to use that for the work in progress in the production scenario. And after going to the work in progress, you are going to see that where it is converted into the finished goods. When the goods are converted to the finished goods, it is going to sold to the customers, where when you are selling the goods on credit basis, so you are going to see that how much receivables you are going to get on that. So when you receive the receivables, again after the credit period is over, so you are going to receive the cash, where in turn you are going to give the cash to the suppliers. So again from the suppliers you are going to get the raw materials. So this full cycle of the procurement of raw materials, work in progress, finished goods, and payment to the customers, and again you are going to make out the receivables, and where the customers are paying back you the cash, and again where you are going to make out the payments to the suppliers. All together it is called as the operating cycle. So when it is a trading company, the operating cycle receives, where you are going to just make the buying from the suppliers. So suppliers helps you for buying the products. So again in turn you are going to sell those goods to the customers, and from the customers you are going to collect the cash. After collecting, you are going to repay it to the suppliers. So all the process whatever involving in this thing is known as the operating cycle. So whenever you are going to see with the operating cycle, so the working capital which is involved in the various business, it differs. Whether it is the manufacturing business, based on that it differs. If it is the trading business, based on that it differs. So what are the current assets and current liabilities you are going to employ in various kind of the business, and also it differs based on the profitability. So when you have the excessive working capital in the business, so that leads to the idle capital which is kept without any returns in that capital. So when you don't have the adequate working capital in the business, that leads to the working capital which makes out the delay in the payment of wages, delay in the payment of advertising, and whatever the production process you are carrying out, everything it get delays. So due to get delaying of the production process, the overall scenario in the business gets affected, so which affects the profitability during the long term process. So next one, what you are going to see is approaches in working capital management. So when you talk about the approaches in working capital management, you are going to see about the various types of financing for working capital. So what are the various types of financing in working capital? So the first one may be the financing through the long term sources. So when you are financing through the long term sources, then that is called as the long term financing. When you are financing through the short term sources, then that is called as the short term financing. And also the third one is called as the spontaneous financing. So what is that long term financing? So when the financing for the working capital is collected from the long term sources, it is like when you can repay the sources of financing. When you repay the borrowing funds for the working capital more than a 1 year of the period, when you use that funds, then it is called as the long term financing. So the long term financing can be done through the long term loans, through debentures and shares, and through public deposits. Okay. When the short term financing can be done with the trade credit, bank overdraft, and also internal financing, whereas the depreciation, the tax provisions, and also for the spontaneous financing. So when you are getting the unexpected returns or money from some place, then that is called as the spontaneous financing. So the working capital can be either financed by the long term sources or short term sources, and also the spontaneous sources. So when it is financed through the long term sources, so you can repay it after a year. When it is financed through the short-term sources, so you have to make it out within a year. Whereas it is a long-term sources means you can pay it after a year. When it is the spontaneous financing, from the unexpected way, in an unexpected way, you are getting some money inside your business. So how you are employing all those money in a proper way, so that is called as the working capital. So here, what are the various approach in this working capital? So how you are going to use this working capital through the financing? So the first approach what you are going to use is hedging approach. Here the hedging approach, it is the time, here it is the working capital. In hedging approach, this one is the permanent working capital, whereas the working capital which is of the fluctuating in nature, that is called as the temporary working capital. Okay. In the hedging approach, what they are going to do is, it is also known as the matching approach. So the permanent working capital is financed by the long-term sources, whereas in temporary working capital is financed by the short-term sources. So in hedging approach, it is also called as the correct matching approach, where you can find that the short-term sources are made out with the temporary working capital and the long-term sources are made out with the permanent working capital. So next approach what we are going to see about is aggressive approach. So aggressive approach, it helps the working capital on the two types of financing. So one is the short term financing, the another one is the long term financing. So here in aggressive approach, mostly the temporary working capital and the permanent working capital, both the working capital are financed by short-term funds. So why it is called as the aggressive approach? Because with the short-term financing, they are going to make out all the working capital needs. So they will drag the payments how much ever they can. So with the small availability of capital, they are going to make the payments to the other creditors and everybody. So how much ever with the small amount of working capital, the firm always aims to make a more profit in the aggressive approach. So the next one what we are going to see about is it is called as the conservative approach. So in conservative approach, mostly the long-term financing are used. So long-term funds are mostly used for implication of the permanent need on the working capital and also for the temporary need on the working capital. In this conservative approach, always you can find that there is a very conservative approach of the firm, where all the payments are made from the firm without any delay in payments, and also the major portion of the capital is locked in the bank without any returns. Now let us discuss what are the various factors that influence the working capital. So is it important that to know that what are the various factors that influence the working capital? Yes, it is sure that based on the business scenario, so you need to maintain the working capital. So when you have the more number of business, when you have the growth in the business, automatically you need to increase the working capital, and which leads to the increase in the fixed assets also. So apart from that, there are various other factors which also influences the working capital. So let us take a look. The first one is the nature of the business. So based on the nature of business, the working capital, what you are going to maintain also, it differs. So when it is the business of the manufacturing process, the working capital, what you are going to maintain is more. When it is a business of the service industry, the working capital, what you are going to maintain will be very low. So it means that when the manufacturing process is carried out, so the operating expenses which is held in the manufacturing business is more, whereas in the service oriented business is very less. So here how the fixed capital and the working capital requirement for the various businesses are shown. So when you take the restaurants and BPO centers and all, so the working capital required is only 10 to 20%. Whereas in the case of trading and construction business, the working capital required is from 80 to 90%. So in the case of tea plantation and iron and steel industries, so the working capital which is given is up to 40 to 50% and the 50 to 60%. So we can take a look on the various businesses where the fixed capital and the working capital varies on the basis of the industry. So next one, what we are going to see is size of the business and scale of operation. So when you are having a very large business, so when your scale of operations is carried out through various countries, and where your scale of business are carried out to various places, various territories, so that time you need to employ more working capital in the business. So when it is taken only for the small places, limited number of the areas are covered in your business, so that time it is about that you are going to make out the limited working capital. So example, we can say the Bowanto maybe the working capital is required only for the operations which is carried out only within the country, maybe within Tamil Nadu or within the nearby southern states. Whereas if you take the scale of operations of Pepsi, where it carries out its scale of operations all over the world, so they need to maintain enormous working capital for the scale of operations of the Pepsi. So next one, what we are going to see about is credit policies. So the credit policies is that the amount of period what the credit you are going to give to the customers. So when you are going to deal with the wholesalers and dealers, so the credit period what you are going to give them, so based on that the working capital requirement also it increases. So when the credit period is lower and when you get more credit period from your suppliers, so the working capital required is very low. When you are going to give more credit to the customers and your supplier is giving a limited credit period, means the working capital what is required is very high. So next one is based on the manufacturing process. It is also the gestation period what the manufacturing process is carried out. So for example, we can tell an example of leather, and the other one is the iron and steel. So when you pour that hot core in for the iron and steel, the manufacturing process is getting over. So whatever you are producing, so it happens within hours. Whereas if you take the manufacturing process of leather and the cotton and the threads and all, so it takes a stage by stage process. So when one process is getting over, then it goes to the next process. When it goes to the next process, it takes certain time, again it goes to the next process. So the product, the goods, raw materials which are locked in various processes, also it helps for the more increase in working capital. So when the production activity is completing in 1 or 2 stages, the working capital which is required will be very low. When the production activities are carried out for the various periods, various stages, then the working capital which is required is very high. It happens even in the bell boilers, so where it takes more gestation period for the working capital for the production. So next one, change in technology. So based on the change in technology also, the working capital what is you are using in the business also, it differs. For example, for the irrigation purpose, so when they are using for the manual, it means that labor intensive technology, so you need higher working capital. So the higher working capital is used in the payment of wages. So whatever the instruments what you are using for the irrigation, everything you are using. So when you use more technology in your business, so that time every expenses whatever you are making, it is made as a capital expenses. So the working capital for the day-to-day operations is not needed. So everything is taken as a fixed assets. So when you are making out the capital intensive technology, so you are using the machineries, you are using the good technology, and you are using the advanced equipments, whereas you are going for the labor intensive technology, you are going to make out the wages, you are going to use the day-to-day operations. So that is also, it implies the technology. So next one is rapidity of turnover. So based on the turnover of the business also, the working capital it requires. So for example, when the turnover is higher, so automatically the conversion of the cash from the product and from the product to the cash, the cycle is happening very easily and it happens in a very smoother way. So very easily the conversion process of the goods to the cash and again to the product happens. Whereas when the turnover is very low, so it takes a time for selling the goods. So whatever the working capital you are employing in the business, so everything is locked in that business and you are not going to make out any process. For example, we can take the bike of the Harley Davidson. So where you cannot expect the turnover of that particular bike more. Whereas when you take the TVS 50, so the turnover of that particular business will be higher, where the working capital will be, the requirement is also will be very low. So when any business that converts its cash easily means the working capital required in that particular business is very low. So when the business is not converting its cash easily, where it takes as idle cash, so that time it happens that the working capital what is required is very high. So next one is based on the business cycle. So always we can find that there is a various business cycles. So it is like introduction stage, it is like a growth stage, and it is like a maturity stage, and it is like a depression stage. So whenever you are having in the introduction stage and in the growth stage, the working capital what is required is very high, and also it happens to be that to make out your business in a better way. So whereas it comes for the depression stage, the working capital which is required is, it may be very low. Sometimes if the working capital is locked as a stock in the business, that time the working capital what is requiring in the business also, it makes more higher. So next one, due to the seasonal variations of the business. So due to the seasonal variation of the raw material supply, or due to the seasonal variation of the business selling goods, that also it implies that the working capital requirement makes the difference. For example, silkworm, so you can get the silk during the particular period only from the silkworm. So during the period you have to make out more production of the silk from the silkworms. So you have to give the good ambience for the worms so that you get more silk from the worms. And also we can take that agricultural products. Example, we can take the mango. So for production of the mango pulp, you have to procure all the raw materials whenever the raw material supply is available. So the mangoes can be procured only during the season of production, and it is used for the production activity all over the time. So for the full year you are going to make out the production activity with the procurement of the raw materials during the particular season. So automatically the working capital whatever you are using, so it is locking up inside the business. So next one, it is due to the fluctuation of the supply. So whenever the fluctuation of the supply is higher in the business, so that time you can find that the cost of the raw materials is also higher. So when it is a lower, so the cost of the raw materials it goes high. When it is a higher, the cost of the raw materials comes low. So we can see that the fluctuation of the crude oil. So due to the crude oil prices, it increases and decreases. We can find that. So there is a changes in the petroleum, kerosene and diesel. So and also you can say that the cotton prices. So they will procure during that particular season. So whenever they have the season of the higher season, so that time they will have to pay the more price for those cotton. So whenever the procurement is low, so they have to pay the price for the higher things. So based on the fluctuations of the supply, so the working capital needed also it is high. So when there is a demand for the goods, the price of the goods also it increases. When there is more supply, the price of the goods also it decreases. So next one is the dividend policy. So if you are having to follow the conservative dividend policy, so that dividend policy makes you to pay the less amount of dividend to your shareholders. When you are paying the less amount of dividend to your shareholders, automatically the profit whatever you are earning is kept as a retained earnings. So when you are keeping those retained earnings in your business, automatically all those retained earnings help you for the use of working capital. So the money, the fund, whatever you are keeping as a retained earnings in your business, so it is helping you to act as a working capital. So next one is price level changes. So it is nothing but the prices of the goods increasing. So when you are having that the procurement of the raw material is higher, and when the prices of the raw materials goes up due to the price level changes, so automatically you need to increase the working capital which is employed for the procurement of the raw materials. At the same way, when the wage rate of the employees also it increases, so you need to increase your working capital to be employed in the wage rates. So overall when you see that, so the working capital whatever is needed for your business production activities it raises, so automatically when the price level also raises. So next one is the earning capacity. So when the earning capacity of the firms are higher, okay, so when the earning capacity, like example we can say the Microsoft, when the Apple mobile phones, so where they are having the higher earnings, so at the same time they are earning more profit. So when you have the higher earnings, so for earning more higher profit you need to employ more capital inside the business. So when you have more working capital only you can earn the higher profits. So at some scenario what happens is you need to employ more fixed assets also inside the business to have the more profit. So one stage you are going to implement the increase in working capital, and in the second stage you are going to increase the fixed capital also for growth of the firm. So when in the longer scenario, in the longer period, you can find that there is a good increase in the profit which makes sure that the viability of the business is higher. So next one is the operating efficiency of the business. So it involves the operating cycle of the business. It means that it is nothing but the optimum utilization of the resources. So how you are going to utilize the resources in a better way. So whenever the cash collections are there, so you are going to collect those cash, and where you are going to make out those payments in the effective manner. So So without stopping, without locking your funds idly in the bank or anywhere in the business, if you make out the correct payments and correct receivables in a proper manner, so then it is called as the operating efficiency. So when you have a good operating efficiency, the working capital required is always very less. So if you unnecessarily lock somewhere your funds, that time you can find that the working capital which is required is very, very higher. So next one is the depreciation policy. So the depreciation policy, the depreciation is one of the internal financing requirement for the working capital. So the provisions of the depreciation is less you are making, the working capital required is also less. So it means that when you are making the provisions for the depreciation, automatically those provisions are used will be in the working capital, because the money what is allocated inside the business as the depreciation is within the business. So you can use all those funds within the business as the working capital without making your money moving outside of the business. So when you are having a good depreciation policy, when you are charging the high depreciation on the assets, so you can have very less working capital, where you are taking your depreciation as an internal financing for the working capital. So next one, what are the other factors that affects the working capital? So other factors is that based on the credit policy of Reserve Bank of India. So whatever the central bank is aiming as a credit policy, so based on that the banks will be aiming to give the funds for the businesses. So some banks where there is very much interested to give the short term financing, whereas some banks they will go for the long term financing. So based on the situation in the country, so the credit policies of the RBI will be keep changing. So during that time, if we are utilizing in our business in an effective manner all those policies, so you can get a good effective things. Next one is the inventory policies. So inventory policies what you are maintaining. So when you are going to procure the raw materials, how much you are going to procure the raw materials. So what is your warehouse storage point, how you are going to store your raw materials. So how much period of gap you are going to use. So with the various tools like ABC analysis, economic ordering, quantity analysis, so you can order the raw materials when it is getting over. So with those inventory policies also, where the factors are applied. So next one, management attitude and the wages. So how some management it feels like it has to follow the aggressive working capital. Some management it feels that it has to follow the effective working capital for the conservative policy. Some management it feels that it has to follow the matching approach. So if we have seen that three approaches, some management will follow the first approach, some management will follow the second approach, and some management will follow the third approach. So based on that management attitudes you are going to make out. So next one is that government policies. So what the government policies are made out? So based on the situation of the government. So what are the physical policies they are going to follow, and what are the monetary policies they are going to follow. So for what provisions they are giving. So when you are going for the industrializations, so there are certain rules and regulations for the sick industries and for the industries who are not having the working capital but they are having the fixed assets, means they will give the rehabilitation for the sick units. So for all those purposes, so the government policy also it helps. Next one is the transport hazards. So the point where you are going to take your raw materials from the production point and you are going to where supply those finished goods from the production point to the supplier place. So within this time period, so what are the various transport hazards you are having? So you have to see that the time taken from the raw materials to the production point and from the production point to the supplier, from the production point to the customer point. So what is the time taken from the production point to the customer point also it has taken. So what's the cost of the transport for that? So that also you have to make it out. So the distribution policies, the channel of distribution what you are having. So from which place you are going to distribute, for whom you are going to distribute. For example, if the Pepsi company is having the production point in one place means, whereas they are having the distribution points in various places, in various zones, territories. So based from the distribution point, it supplies the goods all over the area. So next one is internal banking terms. So how far your banking terms, bankers help you for the working capital management. Sometimes they give the OD, sometimes they use for the capitals. So they help in the working capital, support for the working capital. So when they are giving the good supports, so you can sell all your receivables to the bankers. So when you sell all the receivables to the bankers, the working capital which is required for you is very less, whereas you are getting very much good financing from the banking. So those working capital can be used in your business. Okay. So next one, we are going to see about the case study on the working capital management by Deutsche Bank, with taking an example of Classic Limited and the Modern Limited. So with this, we are going to conclude this session after watching the case study on the Modern Limited and the Classic Limited. Thank you. Thank you so much. Let us see the case study on working capital management, which helps to understand the working capital management from the Deutsche Bank. So working capital management. Working capital management is successfully leveraging liquidity and optimization for more profit. Working capital management is closely correlated with financial chain management. Concerns all companies irrespective of industry, current situation and performance. How exactly working capital works? Company purchases goods and raw materials from suppliers, stores the goods during and after production process in warehouse, supply the goods to the customers or buyers. This cycle takes place usually. Company gets liquidity back when manufacturing goods are sold and based on credit period and collections are made. So how we are going to apply the working capital management? Optimizing various processes through effective management. Amount of liquidity, capital realized, used investments and new markets. Example, we can take with two companies. One is the Classic Limited, another one is the Modern Limited. Classic Limited takes opposite approach of Modern Limited. It enhances the credit worthiness, highlights the invoices drawn on sales and receives on them. Whereas in the Modern Limited, it applies the payment terms, uses banker for financing working capital, sells receivables to bankers. Classic Limited later, to boost sales, it extended the payments and consequently waited for the long time for its money. It has the loyalty to customers where it cannot use its working capital for the fresh issues. Whereas the Modern Limited, with the payment terms, tie up with the bank, selling its receivables to banks, Modern Limited getting finances from banks whenever needed. This benefits Modern Limited in liquidity inflow is higher, chance to acquire new customer acquisition, reduces the risk from uncollected debts. Classic Limited maintains high inventories to avoid supply deficit, which input makes them the more working capital, whereas Modern Limited maintains efficient stock warehouse process so that right amount of stock is available all time. Conclusion, unlike Modern Limited, Classic Limited needs high level of financing. Comparatively, Classic Limited need to maintain high inventory and accounts receivables, which heavily occupies the balance sheet. As a result, there was no new investments were made by the Classic Limited. Efficient management of working capital helps Modern Limited with more liquidity, does not need with any bank loan, and it also enhances the more profitability. So what plays here the bank role in this? It supplies the financing. So whenever the finance is needed, it makes for the suppliers the payables. And it also enhances the pre-shipment activities for production and production-oriented process. It also manages the receivables management all over the world. So thus, banker plays as a very big intermediary and support their clients of the working capital management in the range of ultimate dynamic solutions. Thank you.